Today we have a panel discussion on current VC angel investment scenario in India. And we have very eminent panelists today who have vast experience in this field. I have already circulated their brief CVs, so I will not take too much time in introducing them. And they are our own alumnus. They don't need much introduction also. We have with us on the panel today Mr. Adarsh Sharma, PGP 2009-2011, currently revenue lead in FS Life. Dr. Preet Thakur, PGP 2005-7, co-founder and director of Glamyo Health, a very successful enterprise. Mr. Shankar, who is PGP 2011-13, an investment professional, is currently building a startup Well Fund, a sustainable asset financing startup. Mr. Tushar Agrawal, PGP 2012-14, partner Dexter Angels. Dr. Mayank, Gurnani, EPGP 2009-10, currently program director, JUMPstart NUS. So we have two doctors also on the panel, should anybody have a problem. With this brief introduction, I now invite Preet Singh, who is part of the Equity Club, to continue the proceedings of the panel discussion. He will basically moderate the discussion. So Preet, all yours now.
Yeah, so thanks. Extending again a warm welcome to all the esteemed panelists from the side of Alumni Office and Equity. Our panelists have a diverse set of experiences, and it will be really interesting to understand their perspective on the contemporary buildings and future developments in the Indian startup ecosystem. So first of all, I'd like to kick this off with trying to understand what interests the panelists in this profession and how does their day look like. So anyone can pick this up.
So I think once you get into the world of startups, right, it's always very interesting to see what's going on, figuring out what's working, what's not working, and just looking at different business models and see what's new that is happening out there. And being an investor kind of just becomes a very interesting way of doing it. It's very easy to just be an armchair expert and give your commentary about, oh, this is a stupid idea or this is a great idea. But putting your money where your mouth is actually the best way of actually having a say. So that's how I got interested in the field to start with, that, okay, can I make decisions on this startup actually make sense or not? And the fact that I had the fortune of working with some good startups like Rebel Foods, Zomato before that, I thought I had a fair idea about what works, what doesn't work. And that's how I got started. But the real reason was to stay connected with the field and to talk to new and exciting entrepreneurs who help you stay on top of your own game as well, because the more entrepreneurs you meet too, the energy is kind of infectious and it makes you become better. So that's largely my interest in the field and why I actually started off.
What you mean is that your experience of working in a startup has led you to become a VC and invest in the startup.
Yeah.
Great. Anyone else would like to share their stories?
I'll share the other way around. So in the years preceding to my starting this startup along with my other co-founder, I was largely a healthcare and a private equity investor for roughly 12 odd years. Had a fairly successful career, invested in 12 odd startups, 3 of which went on to list on the stock exchanges, and few of them were the largest in India in their respective subsectors, right? So reasonably good sort of a startup experience, and in all honesty, we were more of a growth sort of an investor where mortality is obviously very low. Now, what made me switch from sort of an investor to an entrepreneur was essentially in an investor you are taking 10 bets on 10 different sort of founders, right? And it's a 10-year-old 10-year-long cycle that you have to play to reap the benefits of the work or the startups that you've invested, right? Now the time is extremely sort of favorable for people to start, right? That's the underlying message that I would want to give to all the folks who are listening on this sort of a video, that this is possibly the best time for starting up. And if you start up and if you do a good job, right, you can create a disproportionate impact for yourself, for all the stakeholders involved, right? In a fund, you have to play 10 different bets. 10 folks have to listen to you, or at least pretend to listen to you, and some things have to work in your favor. If you do a startup and do it right, possibly you can create a large size disproportionate impact for yourself and others also. So that was the driving force for me to move to the other side of the table.
Right. Interesting. Anyone else who would like to share their stories?
Maybe I'll just add on a bit here. I think
Sure.
in terms of how a day looks like, it depends on whom you're asking, in terms of hierarchy and between VC, PE and all of that. I worked in a family office on Refix Capital. And so we were investing in startups. We were also looking at solar deals. We eventually acquired one large developer called Sun Edison. And we also invested in solar. So that is an infra investment. And as opposed to the other side was the VC investments. So infra, you can kind of equate it to a PE investment. So I think typically in the VC space, I would say a lot of my time went in networking, talking to people. Even in Indore fund, I think 80% of the time, Preet, Adarsh, all of us talk to new startups. Deal flow and talking to you guys was taking a lot of our time. And then some bit of time goes in the paperwork, documentation, diligence, and all of that. Post-investment, depending on the type of fund, the thesis and the philosophy, whether you want to get hands-on or be hands-off, there's a lot of work post-investment as well. Some of the funds have a separate team for post-investment. So I think in terms of deal cycle, a lot of people will, I think, spend a lot of time pre-deal, sourcing deals, networking, brand building, so on and so forth. And if you were to kind of lower down the hierarchy, then you're looking at sectors, developing a view on sectors, white papers, preparing for IC meetings, so on and so forth. I think that kind of is the practicality of how it works.
Completely understandable. Networking is a crucial, inevitable part of working in the VC. Anyone else who would like to take this up?
Maybe I'll speak a little bit on how I got started. I was practicing medicine for 5 years before I sort of thought about going and doing a PhD. I always knew that I was not cut out for doing medicine all my life. But I think when I went to the PhD, to talking to the guide, I realized it's going to be 5 more years of grunt work, and I don't know what is going to come out of it. So instead of that, I went and started a startup 2005-06. People called me crazy at that time to have done something like that. But actually, in hindsight, it looks like a better decision, because that triggered a path to me to see how what are the problems in healthcare and how they are being addressed. So for me, I realized that very early that digital is the way for all the inefficiencies within healthcare. And we have seen that for banking and finance now. We don't call digital banking anymore. We call it just banking, because digital is just taken as it's going to be there, right? And I see that happening in healthcare now. So 10, 15 years down the line, now I see, having worked in global organizations, and then now in Southeast Asia, looking at what's happening in China, Australia, and India, I feel that this is the moment when healthcare is going to get transformed. 10 years later from now, or maybe in 5 years, you wouldn't call anything as digital health. You will accept it as healthcare. And to me, that is the biggest driver of being in this space.
Interesting. So, Tushar, would you like to add something?
Yeah, I mean, to just give a sense of typically what a day looks like for an investor, because I've been investing full time for the last 6 to 7 years, early stage investing. I think I try to compartmentalize my day into reading and then networking. So first half of the day, I typically spend reading about what's happening in different sectors in the industry. And the second half of day is largely going into doing calls with entrepreneurs, first calls, follow-up calls, doing diligence on the opportunities I'm evaluating. Also, I have to take out some time to sort of work with the portfolio companies and try to sort of manage my time accordingly. So, I mean, that is typically what you're doing in this industry. It's very high frequency kind of investing, very different from public market investing, where you spend a lot of time in doing research, secondary research. Here, you have to inevitably talk to people to understand what's happening in different sectors.
Right. So, moving on, I'd like to touch upon the Indian startup ecosystem. We all know that mindsets of younger generation is changing. We have better opportunities, and Indian startup ecosystem is growing exponentially. So, what are your views on the Indian markets, and how do you see the investments in the future?
Yeah, so probably I'll take this question. Considering seeing the ecosystem for last 6 7 years, right? The ecosystem has matured a lot. I think last year, 2021, we sort of received around $40 billion in VC, which is like 4 times of what happened the previous year. What has changed is there are a lot of second-time entrepreneurs who are coming and building ventures, right? So there's a lot of knowledge in the ecosystem about what to do, what are the things to do, and what are the things to avoid. There is a lot of people who have also made money being a startup CXO, and that money is coming back into the ecosystem in form of angel investing or VC funding. So a lot of smart money coming in the ecosystem. There are a lot of exits also, which have happened in the last few years. So people have seen liquidity. So overall, if you'll ask me what has changed in the last few years is that the ecosystem has matured a lot, right? India is the third largest startup ecosystem in the world. And even though we will see we will see capital cycle, right? We'll see period where there is, a bubble forming up and period where there's a bubble bursting. But overall, if you'll ask me, we are sort of moving in a positive trajectory, and sort of ecosystem has become much more, stable. So yeah, I mean, in the last few years, I have seen enormous amount of founders coming up, starting their ventures, a lot of new funds coming up. So overall, things look pretty positive for the ecosystem.
If I may add something purely, at a slightly vain level. Right out of Indore, right after working at Vodafone, which was my first job out of campus, after about 8 months, I decided to enter the startup world when I joined what was back then Fasos and now is Rebel Foods. And I remember it was, for most of my friends, relatives, family, like a very weird decision. Like, why would you leave a company of the scale and respect of Vodafone and be joining this company who nobody even knows of? It's such a well-respected job. वहाँ पर, you'll have to be, I don't know, making roles or something of that sort. But now working for a startup is not just accepted, but I think in large ways quite celebrated, right? Be it doing your own startup, be working for a startup. So at a societal level, the mindset change which has happened towards startups in the way your peers, your friends, your colleagues, your family perceive startups has changed so much over the past few years, that just shows the direction that we are moving in.
Sure, definitely there is a change in perception now. So, moving on, we all know that there's a lot of subjectivity involved in evaluating startups. So how do you evaluate management teams, let's say, or what are the red flags that you see while evaluating a startup? So I'd like to direct this question to Mr. Preet first.
Yeah, hi. So I think I've been on two sides of the table, first evaluating startups and then getting evaluated from the funds, right? So maybe I can put color on what happens from both sides, right? So essentially, when we were evaluating these startups, we used to follow for selecting the industry a top-down sort of an approach, right? For example, at that point in time, airlines was one of the industries where possibly you wouldn't want that much time spending that much time, right? Because top-down wise, it was not a very sort of a lucrative opportunity, right? But healthcare was a very sort of an attractive sort of an opportunity, right? Once you have decided the industry in which you want to sort of operate, then you are better off starting from grounds up, right? Then you start with who are the people who would be running the show, right? Essentially, the first port of call is because, this I can also vouch from my own personal experience as an entrepreneur. See, what I thought in 2019 end would Glamyo look like? Glamyo is anything but that, right? I mean, so we've had to pivot maybe 20 times, right? Pivot in the sense, not really pivot, but small sort of a directional changes where our sort of initial thoughts have had to change, right? And over a period of 18-20 months, if you look back now, and if you had things written on a Word document that I will do this on, let's say, January 2020, and what I've done is radically different, right? And that's the nature of the startup, right? So you essentially identify the folks who would be running the show, whether you have sort of a requisite trust in them. Trust will come from many factors. For example, if somebody has done a lot of work in D2C space, obviously he knows about D2C space and his startup is in D2C space, then you are more likely to trust his thesis on it. Trust will come from whether if they're also putting a lot of their skin in the game, right? I mean, so what is their own skin in the game? How much capital have they put in? How much sort of an opportunity cost they are taking? What kind of a risks that they are taking? That's one. Then an extension to this would be, what is the team that these guys are able to sort of build, right? So essentially, founders and then the first level of management is what you will also sort of look at while evaluating the startups, right? I mean, so essentially, I mean, what you're trying to take in a very early stage startup, your bet largely is on people. As you sort of move across the value chain and start moving towards growth stage, your bet starts sort of coming more towards systems, processes, scale, possibilities, right? That kind of metrics start to dominate. Maybe Adarsh and others can also add, because I'm sure I would have left many points which are important.
I think at a very early stage investing, which is largely what I have done, team becomes the most important factor, right? You want to choose the right industry that people are going after. So obviously, if there is a thesis or your own analysis which tells you that this particular area is something which is unlikely to flourish for XYZ reasons, but an amazing entrepreneur may want to play in that field because there is passion involved or whatever, you may still want to stay away from that. But as long as the field that they're going after has a lot of potential and the team is amazing, there are just people where you feel and you meet them and you feel that this guy is going to figure it out, right? They will make it work even if there are challenges, etc. Because as Preet rightly said, no startup, irrespective of whatever plans you make, plans change every 3 months or every month. So, what your vision is, etc., beyond a point, doesn't matter. You have to be a phenomenal founder, and you need to be playing in a field where you, as an investor, you feel that there are, significant large scale outcomes which could be achieved. Yeah.
Definitely, the level of commitment from management team matters a lot. Mr. Shankar, would you like to add something to it? The red
Yeah.
flags.
I think one of the things, there's always been a debate, I think, from whatever I've seen, right, between choosing a team versus weighing the scales on team versus product market fit. And in early stages, I would probably say it scales more towards a good team, even if PMF is not there. I'd like to, I think, just add one point, which I was actually going through, listening to one of the podcasts from Matrix. They call it, I think, Matrix Moments, in which MD of Matrix, I think his name is Bajaj. So he says that how do you look at a great entrepreneur, and what is the mark of a great entrepreneur? And I think from years and years of experience, he narrows it down to only one thing. And he says great entrepreneurs chase large profit pools, and they have entire kind of podcast on profit pools. Very interesting. Maybe I should look at it. And that kind of struck me. And good entrepreneurs go for it, go for the sky, right? And they, not large markets, but large profit pools. I can even choose car, which is cars, let's say, right, a very mature kind of a segment. Yet choose within that value chain something which has a larger profit pool. In the case of cars and automobiles, it's actually financing. And actually, I think, leasing is what is the biggest profit pool, right? So good entrepreneurs go after large profit pools. I think that is something I would look at. But more from operational perspective, some of our investments from Refix Capital, I'd like to look at red flags. One investment we did turned out to be bad, in the sense that they went on to start something in the side and things like that, right? Fraud. You like to kind of avoid that. At one point, we were thinking we should do forensic on all the entrepreneurs that we have. They defaulted on borrowings in the past, things like that. Very like how you do hand loans in the market, right? Something of that sort, which we were contemplating of doing because you'd like to kind of, as a base case hygiene, avoid fraud and fraudulent actors. But yeah, otherwise, I would, if you look at making a mark, I think I would look at entrepreneurs chasing profit pools, large profit pools.
And I would just add to what Shankar is saying. I read somewhere that there are three things. There is intelligence, there's energy, and there is integrity. And if you don't have integrity, you can forget about the other two. So if you do not have intelligence and energy for an area and still have integrity, that's still a positive. But if you just try to do things without it is apparent, it is clear that you do not have integrity, then it is a red flag.
So great. So looking at the current trends, which are the sectors or industries the PE VCs are looking forward to invest in? So I'd like to direct this question to Mr. Tushar. If you can take this up.
Yeah, sure. So, I mean, each investor is sort of working on different fields, right? So each one will have a different thought process on what sectors are futuristically great bets or not, right? I mean, in general, if you look at what's happening in the economy, is that there is a vast theme of digitalization in the economy, right? And it started with, let's say, Indian consumers. I mean, Paytm, Zomato are now names in your houses, right? But if you'll see largely, I think SMEs and enterprises are still, let's say, not completely digitalized, right? I think it is one of the larger themes, macro themes, which is going to play out in the coming future. And then you can dissect it into law sectors where the impact of digitalization is really high, right? Be it health, be it fintech, I think there are multiple sectors which are going to be sort of affected by this. Secondly, I think in terms of technology, there is a lot of development which is happening on the artificial intelligence side. And artificial intelligence is now becoming sort of a commodity tech which can be used by entrepreneurs from the very start, right? So I think because of this AI impact, a lot of businesses, a lot of new business models will come up. Like in case of fintech, complete API infrastructure is being formed, right? I mean, in health, we are seeing impact of AI significantly, right? So, I mean, these are some of the themes which I think are going to play out in the coming few years. I mean, I'll leave it to others to discuss it out.
Yeah, just to add, from a China and Australia perspective, and a little more regional and global compared to India, there are four new economies that are sort of changing, and the way we look at them. There is digital, which is all conservative old industries transforming through digital means, like healthcare doing right now. Banking has already happened. Other areas, biotech, etc., will follow. There is green economy, whereas ESG and similarly targeted areas where you sort of look at how are you taking care of sustainability and urban living. There is the care economy, which is taking care of yourself and your loved ones. So either wellness or through exercise or direct healthcare or whatever. And there is the enterprise for innovation 4.0, which is enterprise tech, which is whatever is helping the transformation of manufacturing or of the 21st century, whatever was happening in manufacturing and taking it to the next level, like robotics and things like that. So these are four core themes which are sort of building in this area, and the Chinese and the Australians take a special view in all these four areas. So from a Indian perspective, I think we have seen a lot of consumer level activity and much less deep tech activity, enterprise tech activities. But I think it's slowly building up, and we are seeing more and more sort of startups in that area. In fact, if you look at this pressure, the funding winter that everybody's talking about, I think it will lead to even further pressure on enterprise tech kind of companies. And rather than B2B businesses, rather than consumer level businesses, which need a lot of cash for acquisition of customers and expanding market share. So those which allow you to sort of have some kind of hook and get capture industries, large industries or large potential clients is likely to be more useful, more likely to succeed in this area during this funding winter.
One thing I'd like to add and deep dive a little bit on what Mayank mentioned is green economy. Energy transition, I think, will be a big part of next decade. There's a lot of noise around solar. Solar has been around, but there's a lot of noise around hydrogen. And hydrogen, we think, in the clean tech sector, we think is going to be the next big thing. And how the world operates. World used to operate with oil, and it's going to be operating with hydrogen and maybe combined with solar, geothermal, and so on and so forth. Right. So I think a lot of emphasis is there on energy transition within the segment of sustainability. And even if you look at the golden triangle of capital allocation, right, which is the insurance funds, the pension funds, and the sovereign wealth, between these three, these are the big players with big monies who are the LPs for private equity funds and also VCs in some cases. And there again, there's a lot of allocation for green and sustainability and so on and so forth. So climate change and associated sectors, I think, will kind of take a lot of focus going forward. One of the mega themes within which there will be undercurrent of fintech in climate, AI, ML in climate, and so on and so forth. But sectorally, if you look at it, I think that this will be one large trend that can kind of going to take off in the next 10 years, because that's the amount of time we have anyway, right? If you look at the the seminars and all of that, 1.5 degrees, and we have, I think, about 400 billion of 400 billion ton of CO2 that can be emitted. So you have about 9-10 years to kind of limit to that. So yeah.
Interesting. I mean, these new things which are coming up are really exciting, but what troubles me is that how do you go about its financial valuations? Means you need to put a number to it to value it. How do you value its exit opportunities and so on and so forth? Mr. Adarsh, would you like to shed some light on it?
So guys, when it comes to early stage investments, especially valuations, as long as it is not completely out of the whack, is not really the biggest concern, because it's also largely a factor of demand and supply as well, right? I mean, a deal which is very highly sought after will go for a higher valuation. Entrepreneurs who have a very solid track record, and investors will be willing to pay them a higher valuation, versus entrepreneurs who are probably first time, who do not have that great a track record, etc., will be able to would be willing to give you much lesser valuation. But that also kind of is directly proportional to what are the chances of success, right? So there are startups where the likelihood of success is a lot higher, but you have to pay a higher entry valuation. So especially at an early stage, this ends up not being the biggest concern. As far as I am concerned, the key is how do you get into the best deals, where some other higher profile investors are also there, or the founders are coming from such amazing backgrounds there. The trust, as Preet earlier mentioned, that they will succeed, or the likelihood of success is much higher compared to other deals is there. Then whether you are paying an entry price of $5 million or $10 million, so while it is 2x, but in the larger scheme, it doesn't matter much, because because what it changes is whether you get 50x or 100x, but when you enter, even if you get 50x, I'll be happy as an investor.
And I will contrast this to a late stage deal. For example, in my role at Cipla as a corporate venture principal, the idea was, what does this deal help us in our current business, or does it open a new market for us? And what I saw very commonly at that time was founders were leaving money on the table because they really didn't understand how this would help Cipla gain 5 market share points, or how it would help Cipla enter into a new area altogether. And I wouldn't take names, but there were examples where startups actually did not value themselves as well as we did through our internal workings, because they simply thought of themselves as service providers to us, whereas we saw them as strategic value builders, where they're helping us grow into an area which Cipla has no strength in. For example, accessing physiotherapy clinics, or accessing another sort of new area, dentists, which we have no current sales force looking into. So I think at a late stage, when you have a strategic sort of investor available, the thinking should be, what value does this add to that strategic? It's not it is less financially viability, but more strategic sustainability and competitive advantage that the new area brings. So does it bring 200 customers ready to go on my pipeline? Does it bring me a new way to bring my product to existing customers? Does it mean that I can sort of upsell a customer or cross-sell a customer? So those kind of things are sort of relevant at a later stage.
Great. So, but this was the case in which we had a strategic buyer towards the end. What about if there is no strategic buyer, or we are thinking to exit via some other route like secondary sale or IPO or something?
Yeah, I mean, secondary sale and IPO, I think that is a later stage. So there has to be a price discovery at some point that will happen. And then industry norms dictate a lot of these sort of, if you are the first in an industry, you are sort of setting the stage for that. But the way we have seen, at least in the Indian ecosystem and even to some extent in the Asian ecosystem, is that ideas have been successful in the West and they have been sort of replicated in this ecosystem. And of course, there are improvements made, but you get a sort of a benchmark from whatever has happened. So that gives you some idea of price discovery. But it also is a function of, getting investors is like taking a bus. You should not jump into whatever comes the first. You should look at which is the right one, which takes you to the place that you want to go. So it is sort of like a little bit of give and take from the founders. Founders often forget this, especially first-time founders. They forget that they should not be riding into investors which are not right for them, and those investors will take them to another place which they actually did not intend to go. They should have waited a little longer for the right bus to come. So that sort of thinking also is important. Don't rush to get whatever is the first one. It's like sort of like dating. Don't marry the first girl you date, sort of situation.
Interesting. So I'd like to ask now that, is there any particular deal that might have caught your eye or had significant challenges that you might have had to overcome? Any such example that come to your mind? So I'd like to direct this to Mr. Preet.
Yeah, so I think I would have loved to invest in Google at some point in time, but I think I couldn't see that Google was coming. The jokes aside, and Adarsh and Shankar both are on this call. So in our first sort of a fund, while the idea for us to start that fund was to start fostering the entrepreneurship ecosystem in the campus, right? That was the idea with which we sort of started, right? So over the course of action, I think few transactions, I think where we can certainly call it that we did miss the bus, and few transactions where I think we overestimated overestimated the role of a founder in generating funding. Have sort of given lessons to us, right? So one startup where I think the founder was coming from a private equity background, right? So our going in thesis was largely that this is a new space. B, the founder is coming from a background where he is already working at a VC, so he would be able to sort of sustain at least till Series A, Series B, right? And that thesis didn't actually pan out in that manner, right? So I think the learning there was to sort of maybe look at the depth of the sort of a sector that we were entering, right? Which in hindsight, I can say, right? And on the other side, we did actually sort of miss some of the startups where we, at least I was not very sort of convinced on how things will pan out, but fortunately they panned out very well for the startups. Adarsh, you would like to add something?
I think since you mentioned about challenges, I think there was one particular deal that we made from the fund where getting allocation became a big problem. So from the time that we entered discussions into that deal to finally getting through, it became such a hot deal that every investor in town wanted to get into it. So, the valuation increased 2x from where we initially started, wanting to invest at. And secondly, it also the amount that we wanted to put in, that we'd initially said that okay, this is the bare minimum that we will invest in any deal that we get into, but we were only getting allocation of about 60%. But the overall conviction of the entire team on that deal was so high that we still went ahead with that reduced allocation and higher valuation. And that too required quite a lot of convincing of the founder on why we are the right partners and we should be involved in the journey. And the fact is that that is right now the best deal in the portfolio, and most likely is going to return the fund and plus some more for us. So yeah.
I think not from the fund, but from my other work experience, one of the deals I did was Sun Edison, and they were a large developer but filed for Chapter 11 bankruptcy in the US in April 2016. And the India piece came to us November, December 2016. But the deal was so complicated; it was a stressed asset. And it took us about 1.5 years to actually go through the deal. We completed it in May 2018, if I remember right. We did part closing, so on and so forth. So yeah, I think the challenges were, I think some of it, since it was a cross border, there was a lot of RBI claims, then there were VAT claims. Some of the contingent liabilities, if had come true, would have been, I think at that time it calculated 10x of the deal consideration. So that was pretty tough. We had to ensure that we don't get hit by the liabilities, manage that, and so on and so forth. So yeah, without going into too much specifics, but stressed assets from my limited experience tends to be difficult because there's a lot of baggage that comes with it. This was one such baggage, but I think with that also there is opportunity because you get it at a cheap price, and therefore if you keep at it and you work at it, and now actually Sun Edison has turned around, we raise more capital, they have 300 employees in India, right? So that turned out to be good, but it did take a long time. It was very challenging.
So we had earlier mentioned about new industries coming up. So I wanted to know what is your take on the regulations that come with these industries, because regulations pose uncertainties like investing in fintechs. There was a recent directive also by SEBI, which seeks the details of startup valuations from PE VC funds. So how do you manage these regulations, or what is the degree of threat these regulations pose on PE and VCs?
So maybe I'll start first. I come from an industry where regulation is taken very seriously. For releasing medical products to the marketplace, you have very serious regulations. It's sort of like the banking industry again, where it's very important to maintain compliance. So for us, when we look at new ventures which are sort of entering this space, if they do not have an understanding of how the regulations apply to them and how they are going to meander or go through it, it is a negative. Because if they do not understand, what is happening right now and what is the direction that's going to take, and they do not have plans around it, you can't do it. But some industries or some countries are more sort of regulated versus others. For example, the EU typically has very high financial, healthcare, privacy, consumer regulations. This is a well-known, well-accepted fact. So if you have startups which are sort of looking at the EU marketplace, they will always have some kind of strong regulatory environment around it. Even space is highly regulated in EU. So whereas in India, the situation is the other way around. Regulation chases chases the environment. So they don't see the challenge is that India is growing so fast that regulation is actually coming after post facto, and then it tries to catch up with what is the situation there. The only way this can be, there's an opportunity there for to ventures to sort of take market share when the regulatory environment is not there. But what I look for is plans in the startup on how they will try to maneuver should regulation come in, and have they taken a view of other markets where regulation is taken in and developed some kind of mechanism to go around it. So, for example, if you are thinking of, say, launching a crypto product in the Indian marketplace, have you looked at what's happening in the crypto regulation space, for example, in the US and EU? And those are some of the areas which the Indian regulator also looks at when they design their own regulations for India. So if you have not looked at that, you would not be able to anticipate that there is going to be some kind of TDS for consumer level crypto exits in India. If you would have looked at what is happening at other places, you would have said that you would have realized that the US, they have withdrawal taxes on such kind of investments. So you can't move, you have 30% withdrawal tax in that market. So that would have, those founders would have been better off by looking at what's happening in other environments. The regulation is slightly ahead. So it's an opportunity actually for those who are a little more aware to look around and see how regulation is progressing and then design their product and service such that they capture market now and then later are easily able to adjust to the regulatory environment in the future.
Just wanted to add something which is not exactly on regulation, but in general, I think as an investor, if you're starting out as an angel investor, especially, it is generally very helpful if you focus on areas that you understand very well. Either you have some background there or as a consumer or whatever, because if you understand any area very well, then be it regulation, be it the use cases, etc., come very naturally to you and you are more aware about what's going on in that particular field, rather than going after something just because you feel that it is the hot area out there and therefore you have to be a part of that, in hope of higher returns. But because you do not understand that particular field, the likelihood of you making mistakes, which could actually be huge mistakes, is also very likely. So I focus on areas which I know better, even if they may not be the 200 to 500x kind of return investments, but because my conviction is going to be higher in things that I know, at least I believe that my hit rate is going to be better.
Hopping on to a contemporary building, with the PE and VC firms globally cutting exposure to China, citing the risks that have been seen in the country in the past. How does this change the PE and VC landscape, not only in India but in the entire South and Southeast Asia?
No, I think that while it is positive for so some of the developments in China themselves have created doubt in the minds of the sort of VCs. For example, the treatment that has been meted to Alibaba and his founder, right? And similarly, in one stroke, all the edtechs have sort of become unviable in that country. So that poses a huge sort of a risk, which obviously results in flight of capital, both direct investments and also portfolio investments, right? I mean, so now how much of it will India be a beneficiary? I think some bit of that capital will obviously flow into other attractive economies, and India obviously features into that, right? And within India, we've seen, I mean, barring the last 6-9 months, I think in 2021, we had unprecedented sort of a rush of capital. Number of unicorns that were created was unprecedented, right? And so that all was some part explained by a lot of capital which was available, and part of it was also sort of because of China not being able to absorb the kind of the capitals that China should have, right? So if China's manufacturing startups or China's manufacturing areas are not able to sort of generate that much of VC investments, I think that presents an opportunity for, or presents a level playing field for some of the startups which are either adjacent to manufacturing or adjacent to any sort of a sector which is a derivative of manufacturing, right? So that is some bit of a tailwind for these sectors which have those characteristics. Now, separately, I think the interest rates in US are also rising because of the inflation concerns. So that will also mean that the capital which inherently was coming outside of US will now start finding good amount of returns in US itself, right? So to that extent, that capital will still be reduced than what it was in 21 when there was a loose monetary policy in US. Having said that, Indian ecosystem or Indian startup ecosystem compared to the capital which is available, I think is still enough capital for right kind of assets is available, right? Capital, I don't think in the next 3, 4, 5 years is going to be a challenge for a good sort of a team with a strong idea and a sort of a reasonably decent execution.
Maybe from a China perspective, because here this part of the world is like 70% of the population is Chinese origin. There is a lot of interest in getting China involved, and China itself they take a lot of interest in this part of the world to be investing as a bridge to go out. But what has happened recently has really impacted people's thinking around China, and they are not as interested. Even though I would say that the base effect works. In India has a smaller base, and so it's growing really fast. And China already had a big base, so the amount of growth is slowing. So I think there were some numbers thrown around. First half of this year, India received around 20 billion investments, and China received around 100 billion FDI. So that tells you the size or the base. But then if you compare to what was there in 2019 before COVID, then you would say India was like 10 billion or 12 billion, and China was already like 80 billion or 90 billion. So if you go from 10 billion to 20 billion, that's a big jump for India. But if you go from 80, 90 billion to 100 billion, that's a very small jump for China, even though the scale, it looks like China is slowing down and India is doing much more. So I think the amount of, especially in B2B and manufacturing, like Preet said, the amount of innovation and the amount of work that has happened in China is unprecedented. So it is far ahead. I had the fortune of visiting China. If you have traveled in from Beijing to any part of China using any of the high-speed trains, you will see the engineering level that is there. And if you go into any of the smaller cities and you see the transport and the infrastructure available, it just makes you wonder where has India sort of lost it. So there is no, the base is huge. There is a lot of liquidity inside within China. They don't really need global PE/VCs to actually drive it. The Chinese government itself has a lot of stake into it in driving it forward. So I'm not very concerned. I mean, the PE/VCs global might be concerned because they might be sort of like they say in a idiom, when the two elephants walk, the grass gets trampled. So the global PE/VCs are getting trampled between what is happening between the US and China. But that doesn't mean China is stopping or anything like that is happening. It's still big, and once this cork is released, at the end of this year, we are anticipating China to release a lot of new policies as they open up after COVID. You will see suddenly a big jump in what is happening. This is the anticipation from this part of the world.
Any question anybody has?
Hello, sir. Thank you, panelists, for your time. I wanted to ask a question regarding the skill sets which are in demand in the startup ecosystem. So obviously it varies industry to industry, but are there any specific skill sets you feel that in the Indian ecosystem, the market's unable to deliver on?
Engineers, I think. Engineers. Sorry, Tushar, go ahead.
Yeah, so I think founders on the panel can sort of answer this better, but in general, if you look what the portfolio companies typically are most concerned about, one is everyone wants to do better at digital marketing. Each one is doing something or the other on the data side, so data science. And third, the new models which are coming up are largely dependent on products, right? So product management. I think these three skills, which I feel in general are in high demand, but I think Preet and others can answer better what specific skill sets are in demand these days.
And I'll tell you what. So the wish list that we had compared to that, I mean, the wish list that you would have largely at the beginning of the startup would, I mean, like any founder would ki IIT, IIM folks ho, right, pedigreed folks ho, right? I mean, so the thing that I have realized in last 24 odd months is that in the initial stages, and that was true for 12 odd to 18 odd months of the initial stages, I think we were better off with people who had a great attitude, but even if a lesser sort of a qualification. So I can tell you that none of the sort of folks at our startup came from either an IIT or an IIM kind of a background. I mean, it's a different matter that maybe for a sort of a seasoned IIM guy, we may not be even able to afford him or her in the initial part of the journey. But what I've seen in the first 12 to 18 months is that attitude actually trumps over the skills, right? Because everything is jugaad. In one sense, right? I mean, that you have to figure out a way of getting things done, right? So I've seen people who have succeeded at Glamyo and grown with us. They, if you sort of ask their educational backgrounds, they do not come from any of the fancy engineering colleges or fancy MBA B schools. Once you reach to a certain scale, and after that you need to set systems and processes, I think there a structured sort of a brain starts mattering more. So our second sort of a level of hiring is essentially from people who come with relevant experience and in some cases with quote unquote pedigreed B schools, right, if I may call that so. So my take has been that in the beginning, you're better off hiring for attitude rather than the skills. Skills can be taught, but attitude, I think, is a key ingredient.
So I think both Tushar and Preet have kind of hit all the right notes. Just wanted to add to what Preet said. I think not even the early stages, like even when a startup is mature or reaches a unicorn level and all that, I think attitude remains the most important aspect of hiring in any startup. Fortunately, I've been a part of hiring across different levels in every company that I've worked for. So whether it is a billion-dollar company, whether it is, just having raised an angel round and all, you always optimize for whether this guy comes in and, will give in more than 100%, will easily mix in with the culture, will be a overall positive influence, etc., and will be willing to pick up and learn more and more things. Rather than being stuck on that, this is what I want to do, and therefore this is the only thing that I will do. So those are the kind of people who are not the right fit for startups.
Thank you very much for joining this evening. Thank you, Dr. Preet, Dr. Mayank, Mr. Tushar, Mr. Shankar, and Mr. Adarsh for joining this panel discussion, and we appreciate it. So thank you very much.